So to wrap up the first part of the micro perspective block, we will touch on what it's like to invest in crypto and blockchain companies and what to look out for. For this, I welcome Anthony Pompliano and Mike Cagney, who will share their experiences in a fireside chat led by Ken Seiff. This is Anthony's and Mike's first time at the CfC St. Moritz, so I'm happy to welcome both of you, and of course Ken also. So Ken, may I ask you to take over?
Thanks, Niccolo. How are you? Mike, Pomp, it's great to see you guys. I thought we would do something a little bit different as we had discussed yesterday, which is to make this a fireside chat, but with a roving moderator. So I will ask the first question and tee it up for discussion. I want to ask the first question with respect to Figure. And what appears to be a very interesting and novel strategy, which I've seen only once before, and that is you're beginning to look a lot like the Amazon for lending. Amazon started with a small category, built a monopoly in books. You targeted the HELOC lending area first and have really built a very, very nice early business. Amazon launched one-click shopping to speed the checkout process and give it a competitive advantage. You have 5-minute approval on your funding. Amazon launched Amazon Prime to deliver the final product to its customers faster. And Figure has a 5-day funding mechanism, which is really turning the industry upside down. So all of that impact on Amazon has led it to consolidate a highly, highly fragmented market. Amazon gets in the high 40s, 47, 48% of all new orders that come online. And when it started, its largest competitor was Walmart, which had 3.5% of the market. So Mike, is this a concerted effort on your part to become the Amazon of lending? And if so, what are the next things we can expect to see?
So I think it's an ambitious goal to be the Amazon of anything, but I think you hit on a very important point. The way we think about blockchain application in financial services and in the ecosystem is we really compartmentalize it by lending, by payments, and by exchanges. And we're trying to basically innovate across all three and take the distributed trustless immutable characteristics of blockchain and apply it as a ledger registry exchange. And when we started Figure in 2018, we wanted a very tangible use case for blockchain because we felt that in financial services, there'd been a lot of proof of concepts, but no one was trying to demonstrate true economic efficacy. And so we ended up pushing for the idea of doing a securitization of loans on blockchain. And we encountered a couple of challenges in the beginning of what we were doing, which was one, the scalability of existing blockchain technology and security related to that. We ended up starting off with a version of Hyperledger and ultimately migrated to Cosmos Tendermint in terms of a public distributed chain. We had some challenges with fiat onboarding, offboarding, and so we set up a group of banks we called omnibus banks that created what we coined as digital wallet entries, which are really just stablecoin to allow for transactions on the chain and allow for the bilateral transaction capability blockchain supplies. But the biggest challenge we had was in 2018, and even to some extent now, the industry wasn't ready to adopt. And we went to a bunch of folks and said, look, you really should leverage this technology. It's going to save you. Our thesis at the time was 80, 85 basis points from origination through to securitization using the technology, creating digital assets that are native to the blockchain. And the pushback was, look, we're not ready. The industry's not ready. The market's not ready. And so we actually created our lending business specifically as a first mover to de-risk blockchain. And we did the first HELOC in September of 2018. We've now done a couple $2 billion of those origination through chain. In March of 2020, we did our first securitization, ended up documenting 117 basis points of savings from origination through execution. In August, a third party did a securitization on Provenance where they captured 125 basis points. And so we're able to really demonstrate and crystallize the value of the blockchain as it related to these transactions. And of course, what that meant was that the gas fees that were being paid in to execute and transact on that blockchain were meaningful. And that's what I think is an important differentiation with if you look at Provenance, which is the blockchain that we use, versus much of the ecosystem. The gas fees are pretty significant that get paid into there. And so on the back of that, we said, look, lending is great. Let's build that vertical. We're now doing first lien mortgages. We're doing unsecured consumer. We're doing a bunch of stuff on lending and actually starting to build revolving product, like credit card product on blockchain as well. But what we've done is we've built two other verticals that are key to our strategy. One is payments, where we're using blockchain rail to effectively move stablecoin between counterparties in lieu of using interchange. So we have a function called Figure Pay that's actually launching this month, where you can download an app, create a QR code, scan it, and move stablecoin between any two counterparties with a fiat off ramp through one of the U.S. banks. We think this is a huge opportunity for merchants, because if you look at Walmart, for example, they made $6 billion of profit in 2019. They paid $2 billion in interchange costs. So there's a huge opportunity there. And then we've got what we call the exchange business. And the exchange business is really rooted around everything related to security token exchange. So, private company cap table management, fund custody, administration, capital raising, all things that we're very focused on and starting to build real good, genuine traction again. So, we're looking at being first mover across all of these things, and we get the economic rent of being a first mover. And to the extent that we crowd in participation and adoption, it benefits everyone that's a token holder of Provenance, and that's really the focus of what we're doing.
That's great. Pom, can we shift gears for a second to another Amazon analogy? Amazon launched with books in a large part because the internet was really slow and you could only load text, and who better to shop using only text than people who like to read. It was an incredibly natural category for the first category of selling. I know you have some thoughts about this. Can you talk a little bit about loan origination as a native digital asset and the first one that might work on the blockchain?
Yeah, I think that it really just comes down to automating a lot of the processes and making them more efficient and removing the need for human interaction, right? If you really think about a lot of the things that go on in the financial system, technology solves those problems, but you need somebody who, one, understands both the technology world and the financial world, which obviously Mike does. Two is you need somebody who understands how to use the technology to create an efficient process. But the third real bucket that's been missing is you actually need a digital asset. And I always joke that we don't try to put physical cash into our computers. And so we had to use electronic QSIP assets for the longest time. Now what we're starting to see here is actual digital assets that are able to be transacted by machines or across blockchains. And you end up in this very interesting world where not only do you have an efficient kind of origination process, but then you also get a ton of efficiencies in the back end as well. And I think Mike kind of understands that. And Mike, maybe you can touch a little bit on this idea of, we saw yesterday Brian Brooks, the former head of the OCC, he, in his kind of parting words, said there was this focus on an open internet or an open financial system. And I know that the Provenance blockchain itself started out as, kind of a more centralized type entity, but is moving towards a decentralized public blockchain. Maybe talk a little bit about like why that's important and kind of how you guys see that evolving over time and what the impact on the financial system is to get these to open protocols.
Sure. So, and just to build in on your last point, before I talk about the evolution of Provenance, I think you hit on one of the most salient points, which is you need a native digital asset for this to really have value. And there's so much discussion about let's tokenize, Picassos or token. IBM talks about blockchain for strawberries. That to me doesn't make a lot of sense. If it's not a native digital asset, then I'm not sure you have this huge element of trust between the leap between the physical asset and the chain. And the whole point is you take trust out through a digital asset. And if you're in a circumstance where you have bilateral transaction capability in a trustless structure, that's where the efficiency comes from. And when we think about financial services, we spend a lot of time talking about disintermediation, and there's a huge disintermediation opportunity, right? The custody banks, top 3 have 150 billion of market cap, top 7 exchanges, 125 billion. The interchange network providers, Visa, MasterCard, et cetera, over $1 trillion of market cap. So there's huge opportunity there. But there's huge opportunity also in efficiencies, and then there's huge opportunity in new product development. So being able to do things on chain that you couldn't do off blockchain. And that's, to Pom's point, one of the things that we started with was a version of Hyperledger. It was quasi-permission, quasi-private, because the banks and funds that we worked with had a lot of hesitancy about going into a public distributed blockchain. But the goal is, and ultimately the value has to be in a public distributed decentralized blockchain, because where you're truly creating this trustless structure and this bilateral capability, you can't have any intermediation there. And so, we've been through a process of building trust and understanding of the technology, going through an evolution where today, we're effectively decentralized and nearly public. The only centralized aspect we have on provenance is we still have a provenance entity that provides a bridge into that stablecoin creation. And to Brian Brooks's point, what we're hoping is on the back of OCC guidance that U.S. banks are going to be able to bilaterally issue stablecoin onto chain, and that's kind of the last leg that we need to effectively pull any centralization or any intermediation out of the blockchain structure and get really the efficiencies that decentralized and public offers us.
For sure.
Go ahead. Ken. No, please.
Well, I was just going to say, Mike, I think that one of the key pieces to this is you mentioned kind of what won't work, right, in terms of maybe tokenizing strawberries and that type of stuff. It feels like a lot of these financial services, once you start to decentralize and digitize the systems and the assets, that becomes a much more efficient system. Maybe talk just a little bit, my kind of end vision here is just we get an automated financial system. So anyone anywhere in the world with an internet connection can basically plug into a global financial system, and you just remove a bunch of the bureaucracy, a bunch of the inefficiencies. And it's really more about automation. And I know that some of the processes you guys have built involve a blockchain, but also some of it has nothing to do with a blockchain at all, in terms of like the loan application where you can basically approve somebody in 5 minutes or less, but that really doesn't have anything to do with the blockchain. So talk through a little bit of just like automation versus like the need to, really find a solution for blockchains themselves.
Yeah, and I think you hit a really important point that there's technology innovation and internet innovation, which is happening and available to anyone, and then there's the underlying blockchain, and you have to be very careful about what you put on blockchain, because it's as most of the folks here know, it's a cumbersome and computationally intensive process. And so when someone's applying for a loan and checking out a loan rate, for example, that doesn't need to be on the chain, but when they actually go ahead and want to move forward on an application, then you want to start capturing the immutable record of that, so you have provenance of the origin of the asset you're creating, and have a digital asset for easy transmission. I think the way to think about sort of the first and second order benefits of this is, if you look at the mortgage industry today, when people originate mortgages and they sell them to Fannie Mae or Freddie Mac, it takes about at least 21 days between the time you fund the mortgage and the time you can actually get the loan over to one of the GSEs. And the challenge on that is, when I'm waiting during that period, I'm aggregating those loans. So I'm putting them in a warehouse and paying equity capital to finance those loans. I'm taking on market risk in terms of what happens between the time I originate the loan and the time I sell the loan. And the process of selling the loan involves a huge amount of staff. It's what we call post-close, where they're dealing with getting the loan into the warehouse, out of the warehouse, into the Fannie Mae custodian, out of the custodian, delivering into Fannie Mae. And then Fannie Mae systems are so old and antiquated that effectively they create what are called 55-day mortgage pass-through securities. So when you buy a Fannie Mae security, you're getting cash flows that are 55 days old. And so you're implicitly paying the drop on 55 days of holding that or withholding that cash. So if you fast forward and you think about, well, what if we were doing this on blockchain? You originate a digital mortgage, and you do what we do with our prime jumbo loans or our HELOC loans, which is you sell them immediately when you originate them. And you do this in a way where the origination process is trustless. You have true certainty and perfection into that collateral, and so there's no audit or physical intervention that needs to happen on the delivery of that asset. It's electronic. And then what you're doing on blockchain, in the construct of what we have real-time servicing and remittance. And so as payments come into these omnibus banks, they're immediately posted onto the blockchain. You have real visibility to that, and so you could effectively create a one-day security. And if you think about what this impact is to the industry, in a first order impact in 2019, there was almost $3 billion of warehouse equity capital that was consumed for aggregation, about $2 billion of post-close costs. And if Fannie Mae was able to sell a one-day pass-through versus a 55-day pass-through, they would have generated another $3.5 billion of revenue. And so the first order benefit is to the industry participants, but what will happen is that will be competed away, and ultimately it'll manifest through to lower rates to consumers. And so, like all technology and all good technology, it's deflationary in that construct. And certainly blockchain is a massive deflationary force if it's applied the correct way. And so, we see that everything within the financial ecosystem is vulnerable at this point, and we think we're at the cusp of a pretty significant transformation. And we've gotten broad institutional adoption. I think we have over 45 banks and funds that trade and participate on Provenance right now. Everything from credit unions to large money center banks and hedge funds. And as we continue to de-risk and build knowledge and understanding of the technology, I think we're at a tipping point where you're going to see massive adoption, because the cost benefits of using this, whether it's in euros or dollars or yen or what have you, they're too significant to ignore. And from a competitive standpoint, you can't ignore it.
I wanted to follow up on the automation concept both of you made. We've been spending some time thinking about how far that actually transcends the banking industry. Do you see any banking services or requirements that cannot be codified, that can't be put into code? Will it be possible in short order or long term to have a bank that's just software code with no people and no retail offices? And if so, what's it take to get there?
So you still need someone to answer the phone when people call, and although we're getting pretty good on AI on that front, although you can often tell when you're talking to a bot or artificial intelligence. But look, I think what needs to happen is some of the underlying regulation needs to change. So for example, one of the ironies is you can't originate a digital mortgage in California, because California requires a wet signature deed, a paper form deed that has to exist. And so the way that we create a digital mortgage in California is we have that wet sig deed. It sits with a trustee. The trustee puts a digital token on the chain that says, with an image of the deed that says, I hold this deed, and if you ever needed to foreclose on the loan, you come to me and I'll give it to you. You're trusting that trustee has in fact the deed and will in fact give it to you. And you're trying to eliminate that process. And so I think that the barrier for a true digital experience, front to back, is not so much in the technology. I think it's there. I think it's actually some of the regulatory structure that we have to live within. And there's a lot of headwinds from a regulatory standpoint, because, regulators don't like to be displaced. And if you have a codified electronic system, you can work exactly within the rules of what it's supposed to do. So you don't need a lot of regulation in that regard. So I think it will get there, but I think it's not a technology hurdle. It's actually the regulations that need to get updated and changed. Another example of this, California still requires manual notary even during COVID. And so the idea that California, perceived as a tech forward state, doesn't actually allow for digital notarization when 40 some other states do, is goofy. But that's sort of the last mile that you need to build a truly digital experience and massively reduce headcount.
So what's really interesting, I think, about all of this, Mike, and Ken, you're highlighting it as well, I think, is the technology has gotten to the point where we're ahead of the regulation. And I think that we're seeing a very different response, right? There's some places where people are embracing this and saying, look, let's accelerate it. And there's some places who are trying to fight it. How important do you think kind of the regulation will be in terms of trying to protect incumbents versus this will be, what I'll call like an Uber situation where people just demand the better experience, and eventually the regulations have to conform and kind of adapt and change to allow for the new technology?
Yeah, it's a good question. And having, we're in a situation where we have, I think at this point, 200 state licenses for all the businesses that we do. So we're, steeped in regulation. And certainly a lot of that is written for the benefit of incumbency. We were going through a process with SEC and FINRA, and the SEC process went relatively smoothly. And with FINRA, it was around the ability to support bilateral transactions in an exchange on the blockchain. And obviously, if you're really using blockchain, you're going to have bilateral transactions. You're not going to have any need for intermediation. you can designate with stablecoin and with digital assets that the counterparties either hold the fiat to transact or they hold the asset to transact. And we were trying to explain this structure, and they kept asking, well, what happens when the trade breaks? And you want to say, well, it's impossible for the trade to break. That's the whole premise. Like the order is the trade, and you can't not deliver. You can't not have the cash. But when you say that to someone who's been in the financial services industry for 35 years, they look at you like you're an idiot and say, look, I've been in the industry for 35 years, trades break. What's going to happen? Who are they going to call? There's no centralized entity. And so I think it's both regulation protecting incumbency, but it's also just the financial ecosystem hasn't really evolved in 30 some years. And so this is a real shock to the system for a lot of the people that grew up in financial services, and it really requires a different mindset. So I think it's both those that are things that we have to overcome to really drive change.
I think we've also seen something new emerge out of the pandemic. We've been operating in a world a lot like playing bowling with bumpers. If you want to build a tech company, you build it in San Francisco. If you want to build a finance business, you build it in New York. The pandemic taught us that you could do almost anything by phone, and that's opened up people's minds. And New Yorkers are moving to Miami by the droves, and Californians are moving to Austin for all with the idea that there's better tax rates or warm weather. I think we're going to see the same thing in the blockchain. I think we're going to see regulatory and jurisdiction shopping if anybody hits the industry too hard. So I do think we're going to see some intelligent regulations, and I do think our governments are going to start to work in a little more alignment globally. But I don't think it's going to be possible to regulate something out of existence, because companies will simply decentralize and move to a new jurisdiction.
So I'll shift gear a little bit, and because you guys have asked me a lot about provenance and figure and how we see the industry and the financial services industry. So you both launched rolling funds and are raising capital. So these are relatively innovative structures, and I'm fascinated to hear why you chose these structures and how it's going.
Bob, you want to go first?
Go first, Ken. Nope, you go first.
So for me, it was really simple. I looked at it; it was super innovative. We're raising an institutional fund. The best advice I got from the smartest people was institutions will never do anything new. Doesn't matter how good the structure was. And then I talked to Pomp, and he was doing it, and I tried it and subscribed to Pomp's fund, and it was breathtakingly easy. And the logic behind doing it was awesome. And I decided very simply, this is a much better way to invest in the blockchain space in particular than any other structure that exists. And for me, the tipping point was when I heard for the 15th time the story of the great venture fund, very well known, very celebrated, that put $250,000 into Instagram. And when Instagram was sold, they made $78 million, which was 312 times on their investment. But it only returned about 5% of the fund. It didn't return the fund itself. It required something like 19 equivalent investments in that $1.5 billion fund to have performance. And what the rolling fund does is one of the things it does is it allows you to size the fund for the appropriate moment in time. And this particular industry has an enormous amount of pre-seed and seed and Series A companies, but not a lot of later stage companies. And so we're seeing these mega funds that I think are going to run into the Instagram problem because they're not necessarily sized appropriately unless their goal is to own Bitcoin. And that wasn't our goal. So, I look at Bitcoin and think it's really not an asset that any investor, because it's so easy to buy and so easy to custody, any investor doesn't need a third party to do it and charge it 2 and 20 feet. So for us, it was very simple. It allowed us to keep the fund small, grow it as the market evolved, provided extra transparency for investors on there, or predictability for investors on their capital calls. And frankly, it allows people who are learning the space to start small and grow their own investments in the space, because in our case, we do a new series every 6 months. And so there's a window for investors to increase their investment once they're in the fund every 6 months. Pomp, you probably have a much more articulate answer than that.
I don't know if I got an articulate answer. I think you hit on a lot of the key points. The big thing basically is just from an LP perspective, it is a much better experience and it provides optionality. So if you think about it from, you know exactly when the capital call is coming, you know the exact amount, so you can do a lot better on cash management and just kind of peace of mind. But the second part is there's kind of a double opt-in on a quarterly or every 6 month basis. And that double opt-in is just because you commit doesn't mean that you're actually legally obligated to fund the capital call. And so what that does is it basically holds the GP accountable that if they are going to issue the capital call in the future, the LP still wants to invest with them. And so some GPs look at that as a downside. For somebody like me who is operating as a solo GP, it's a really nice check and balance because the LP basically gets the choice every 90 days whether I'm doing a good job or not. And so it forces me to make sure I'm doing what I said I was going to do and kind of still operating in a way that would make them want to invest. And then I think the second thing is it's a win-win for the founder, right? And, you know, if you take my situation, for example, as a solo GP, I can leverage AngelList kind of software and back end, but I can make very quick decisions. I usually can decide same day if I need to. And the process for a founder is they have one line on their cap table, but they're getting kind of an entire army of people that can help them. And so I think that, you know, whenever you can find something that is a win for the LPs, it's a win for the founders, and then the GP can make it work. That's something that you should go pursue. And so I tried it out in Q4, really liked it, and doubling down on it in 2021.
Should we move to questions, Nicolo, if you're out there?
Yes. So first of all, thank you very much to Anthony, Mike, and Ken for this discussion. So we have here some questions. So the first one goes to Mike. Do you think the whole industry should agree some gold standards? It seems the governments everywhere are behind technology because things they need regulating disappear. Once they are busted, then reinvent themselves somewhere else. Perhaps staking is another version. So is there the need for a gold standard?
I think there's a benefit of some standardization. I think one of the things that, you know, a lot of the central banks are exploring is the idea of a central bank digital currency. And I think there's a huge opportunity to leverage blockchain to eliminate some of the cross-border remittance, the SWIFT and wire structures that we have today. And it's a starting point to build on centralization and acceptance. I think the banks being able to mint stablecoin, you know, and the construct of the stablecoin, the debate around here is if the bank creates stablecoin, do the dollars sit in an escrowed account or are they fungible liabilities for the bank? They kind of need to be the latter because otherwise the bank doesn't have the incentive to create that stablecoin. You don't want a transaction or a friction cost in buying and selling stablecoin if you want the ecosystem to work. So that it really needs to be a fungible liability, and that effectively becomes a credit to the bank. So you're taking on, you know, if JP Morgan issues a stablecoin, you're taking on JP Morgan credit risk. It's sort of analogous to what we had, you know, way back in the days when the banks actually had gold and silver backing the currency that they originated. But I think the ability for banks to begin to do that, and then a fungible market, you know, much like we had with Eurodollars back in the day, will usher in some normalization across borders and globally in terms of how a structure can work. You know, ultimately what we see happening is, you know, every bank has their own ledger today. The reality is that ledger should just be on the blockchain and be one ledger to allow for frictionless and seamless movement of value between any two counterparties, irrespective of border or state. But that's a little bit ways away. So I think stable coins will start the process of a normalcy or a standard in which the financial ecosystem will operate globally.
Thank you, Mike, for that. So I think we had also, that goes also in the regulatory challenges that we spoke about. I have here about 4 questions about regulation, so I just take one. I will address it also to Anthony and Ken. First to Anthony. So in regards to regulation, which one or the regulators, which one is taking the lead and what measures would you expect? Because that what you said, technology has gone in front of regulation, right? That's the problem. So that technology is faster than the laws that we have, and then they try to run. And so what measures do you expect, and which regulators do you see that are in the position to have laws that are, good for the technology advantage? Can you hear me? Can you hear me, Anthony?
I can. Oh, I didn't know if you wanted Ken or me.
Sorry, Anthony. Yes, Anthony. Sorry.
So basically, the way that I think of this is each regulatory environment may be more beneficial for one or other things, right? So what that means is there are certain, take like the country of Pakistan, which is kind of an obscure thing, but basically there are 4 major provinces in that country. One of the 4 is super forward thinking, and they've now started to allocate government funds to do Bitcoin mining. They are starting to embrace the technology, while the other 3 provinces inside of that country have not done that. So that's a great example of like, it's not just kind of a Western world, which regulatory body is doing it. We're seeing little pockets even inside of countries where one of 4 provinces are doing it. When you kind of zoom out, you look globally, I think that you've got to look at also who is supporting what I would call that open financial system versus a closed financial system. So China, for example, has a digital currency that they are pushing. They tend to be less excited about that open financial system and much more excited about kind of a Chinese kind of controlled currency that has, benefits that they see that maybe others don't. I think in the United States, the question is still in the air, right? Are we going to embrace this, or are we going to try to kind of get in the way and bog it down? There's people who in the industry are working very hard to get more kind of regulatory clarity, get more kind of open-mindedness, but I don't think that it's moved at the pace that many in the industry think is necessary. And so the U.S., I think, is still a question mark. But if you look around the world, there's definitely some regions where it's a no-brainer and they're really embracing this. Estonia is a great example. And then there's other places where there's outright bans and the government's trying to control things. So it's kind of a case-by-case basis. We probably don't have time to go through each individual region, but that's kind of the framework I use to think through it.
Okay, thank you very much, Anthony. Yeah, Ken, please.
I'm so glad Anthony brought up Pakistan, because I learned all about it in his very fine newsletter this morning. And I think one of the interesting points that you made in that newsletter is that Pakistan has actually banned Bitcoin. And so you have this adoption of Bitcoin in a country that bans it by one of the regions in the country. We're going to see regulation on a number of fronts. What gives me the most hope in the United States right now is that the pandemic has taught this country and its leadership how important the blockchain would have been as a natural solution for at least 3 major problems we had. In the early days, this country had incredible problems tracking PPE and validating the authenticity of it. The pandemic forced a lot of people to want to vote from home or by mail. And that led to a very, very slow counting and incredible mistrust in the system. And then when it came to the stimulus payments in this country, they were really difficult, and people who so desperately needed the checks couldn't get them. All of these problems were natural places for a blockchain solution. And so as our government is going to go into the next administration, and having witnessed all of these challenges, it seems very likely that the government adoption of blockchain technology to solve some of its systemic and foundational and legacy problems is extremely likely. I think the pandemic pulled forward the adoption of the technology itself. And it's very hard to regulate against currencies if you're going to be using the technologies, many of which require tokens. So I think we're in a moment of time where there's a lot of uncertainty, but it certainly feels like we're going to look back in 5 or 10 years and say that pandemic changed the way we view the technology itself, and it is as a force for good. And so while I think we'll see more KYC and more regulations of choke points and just the places where you can transact from a fiat currency into a cryptocurrency, I think at the same time, we're going to see much more rapid adoption of the technology itself, which I think is very, very healthy for the industry.
Perfect. Good. So I would like to continue here the discussion, but unfortunately I'm Swiss, so I'm really precise with the time. So Anthony, Mike, and Ken, thank you very much for this valuable fireside chat, and I really hope to see you next year here in St. Moritz. I know it's cold or colder where you're staying at the moment, but it's really still nice. So Anthony, Mike, and Ken will now join the networking room. So take this opportunity to ask even more questions there. So thank you very much, and see you hopefully soon.
Thank you.